Hi friends, in the last couple of months what has been happening in Indian market is beautifully summarized in this snippet here. Nifty was all-time high of 20,000 something in September and then it fell back to 18,700 level. So there is a lot of volatility in the market and you will notice that 59% of the stocks delivered negative returns, and it brings a smile on my face because there is a lot of opportunity for us to buy good correction. Please note, I am saying good correction. It is extremely important for us to understand what is a good correction and what is a bad correction so that we avoid bad correction and we take good correction. So in this video, I'm going to share with you my view on 5 stocks that are fundamentally good stocks. And I believe that the latest correction that we are seeing in these 5 stocks is a very, very good correction for investors to potentially take fresh entries. With that, let's get this video started. So the first stock is Jindal Steel and Power Limited. What you see on my screen is what I've done is I've arranged top 100 stocks in their last 1 month's returns order. And if you see, Jindal Steel and Power Limited at the time of recording this video on 6th of November lost close to 15% of its share price. Now, whether it's a good correction or bad correction is what we need to understand. If it is a good correction, there is an opportunity for us to invest in this correction. And if it is a bad correction, we should totally avoid it. So let me give you a quick example of a bad correction. What you see on my screen is Avenue Supermarts Limited. I did a full video on this stock as well. What you will notice in the last 5 years is that stock was growing at a very, very good speed until 2021 October. And after that, it has been gradually falling down. It is not making higher highs. And I explained to you in that video what are the fundamental reasons that the company is struggling right now. Mainly because of their apparel business is not doing well. Their online business is in heavy losses. Also, their ability to open new stores is very, very limited. So in the short term, DMart is not a very good stock in my perspective. And this correction that we are seeing right now is not the right time to take fresh entry into the stock. In the future, if they fundamentally correct their business, of course, there is an opportunity for us to take some positions. And if you see, last 1 year, the stock has corrected by close to 13%. In my view, this is still not a right stock to take entry into, although the stock has corrected by close to 13%. But when I talk to Jindal Steel and Power Limited, you see the last 5 years history here, you will notice that the stock has been making higher highs. So here it was at 479 in May 2021. Then again it fell down, went up back, made a higher high from the previous high, 562. Again after a few months it went up to 610 and then again it made a higher high of 711. Right now the stock is correcting in just last 1 week. If you look at it, the stock has corrected by 3.81% roughly, and you see a sharp fall here from 633 level to close to 590 or 594 level. Primarily, the reason that I will explain to you is their quarterly results. But coming back to the 5 years growth, you will see that fundamentally Jindal has been a growing stock. Jindal Steel and Power Limited is what I'm talking about. It has been a growing stock, have been making higher highs. We need to understand right now that is fundamentally anything changing in the company, and that will tell us whether we should start to take any fresh entry in this stock or not. Let me very quickly clarify why the stock has fallen in the last 1 month or so. So what you see on my screen is Jindal Steel and Power Limited's quarter 2 2023-2024 results, and you will notice that their revenues are flat or down slightly from the previous quarter, and their profits also have fallen down. And typically what you will see with investors is the moment a company declares their quarterly results and if there is a fall in their profits, many investors will dump the stock out of the fear. They would like to book their profits if they are sitting on the profit, which is not a bad strategy at all. But for long-term investors, 1 quarter here and there does not make a big difference. But more importantly, what we need to do is it that the company is fundamentally becoming weaker? And if that is the case, you can decide to exit the stock. But if that is not the case, then you should remain invested. This is where the fear and the greed balance comes into the picture. Now, if we dig deeper and try and understand what is happening in this stock, let me just come down here and you will see the commentary from their quarter 2 earnings presentation. Clearly, what their management is saying is that their sales volume actually was up by 9% quarter on quarter basis. So company is able to sell more steel, happy days. Then the question comes, why the revenues are down? Simply because the steel prices are weak right now. The steel prices have been down almost by 7% this quarter, and that tells us that revenues are going to fall. but the company is able to sell more steel is what really matters here. The prices of steel will vary according to market conditions, and it does not mean that the company is fundamentally weak here. But if you look at the trend of steel prices, you will see that they have been coming down. They have bottomed out literally in August 23, and they are now coming back up slowly. So meaning that the upcoming quarters might give the company better revenues. Also, if we look at the coking coal and the iron ore, which is the raw material in making the steels, that their prices have been going up in the last 1 or 2 months, and that also has a hit in the profits of the company. So all in all, if you're investing in companies like steel company, please understand that the steel prices itself will drive the share prices, and also the iron ore and the coking coal's prices will also determine the company's profitability. So one quarter here and there, you will always see the fall in the revenues or the profits because of these reasons. What really matters is that is this company investing for future or not? So for that, what the company is saying that they are putting 31,000 crore rupees of capex into the company. This number that was earlier quoted was 23,000 crores. It has gone up to 31,000 crores. Simply meaning company is putting a lot of money into expanding their JSO angle plant. Also, they are putting some money in coal mines, new projects. All in all, what that will do to company? It will allow company to produce more finished steel capacity. So from 7.25, they will go to 12.75 in fiscal year 24 and so on. So overall, from my perspective, the stock looks a growing stock. It remains fundamentally strong from its selling capabilities perspective. Yes, steel prices, iron ore prices, coking coal's prices does determine their quarterly profits, but overall, from a long-term perspective, stock remains good. Therefore, buying the dip might not be a bad strategy. Just a disclaimer, I am not saying you go and buy the stock. I am simply doing the analysis and presenting you the right information so that you can do full fundamental analysis of this stock and take your positions accordingly. And if you're liking this analysis, a humble request for you to like this video. Let me know in the comments a simple thank you. It will motivate me to come up with more such videos so that you can be an informed decision. Also, I talk about my personal investments on my YouTube member community. You can consider subscribing that. You will learn a lot about how to go about investing. You will find the link in the description or in the pinned comments. Before I move forward, just a quick announcement that I have also launched my Hindi YouTube channel. You will find the link in the description or in the pinned comments. Humble request for you to go and check it out. And if you like it, consider subscribing to that channel as well. The second stock in my list is Dr. Reddy's Laboratory Limited, and you will see that in the last 1 month, stock corrected close to 3.57%. This being a large cap stock, 3.5% correction is not a bad correction at all. But more importantly, if you look at the last 1 year share price history, you will see that it touched close to 6,000 rupees per share. And right now it has come down to close to 5,300 level. So that is almost 11 to 12% correction from its all-time high. And what that correction has done is that it has brought the PE of this share to 19 versus sector PE of 40. So there is a lot of room for this stock to further grow. Also look at the PB ratio. Also it remains less than the sector from a PB perspective. So all in all, from a valuation perspective, it looks to me undervalued from a sector perspective. And also if you look at its peers, you will see that likes of Sun Pharmaceuticals, Cipla Limited, Mankind, etc. are at an extremely high PE. So if you were to pick a pharma stock right now, it looks undervalued as compared to its peers and sectors. But let's also understand whether it's a fundamentally good company or not, and more importantly, why the stock is correcting. So the key reason of this stock's fall in the recent days might be due to this news that Dr. Reddy's faces 9 observations after the US FDA inspection of Hyderabad unit. So after this visit by US FDA, what has happened is they have issued 9 observations to their process, because when you are manufacturing medicines, your process does not have a lot of room for errors. It needs to be spot on. And more often than not, pharma companies are periodically reviewed for their processes. And if there are any observations, then the regulator will issue those regulations for you to take corrective actions. As long as the company can correct those errors in time, then what happens is that it's all fine. You can start selling or manufacturing the goods again. And if you look at the commentary from their quarterly investors presentation, somebody asked this question, the very first question, that you've got 9 observations about your biological plant. What are you doing about it? And very simply, their senior management is saying that all these 9 observations are addressable. It means by the beginning of November, the company will make these processes correct. But what happens in the short term is that when the news goes out in the market, what people think is, oh, there's a big problem with this company and we are already sitting in the profits. Let's just get rid of the stocks, make some money. And that sees a short-term pain in the stock prices. And therefore, as long as the company's fundamentals remain good, there is an opportunity for people like you and me to take fresh positions. Again, I'm not recommending you to take the positions in this stock, but I'm simply telling you my way of analyzing the stocks whenever there are some corrections. Now the question comes, is the company fundamentally strong or not? For that, let's quickly have a look at the revenues and profits in the last few quarters, and you will quickly see that from September 2021, the revenues from 5,700 crores have gone up to 6,900 crores. In fact, quarter they have done better from a revenues perspective. Also from a net profit perspective, 996 crores back in September 2021 has gone up to 1,482 crores in September 2023. So they have done 1.5 times of their profits in the last 2 years. I think for a large cap stock, this is a very, very good profit growth. So from a fundamental perspective, from a profitability perspective, I don't see any issues. We have also seen the valuation of the company from a PE and PB perspective tracking at lower than the sector values. So all in all, this might be a short-term correction. The stock might go back up to its previous levels. Who knows? My point is simple, that you can analyze these correction and try and find out whether it's a good correction or bad correction, and accordingly you can take positions. The third stock is HDFC Bank, which has corrected close to 3.74% in just last 1 month, and I think it is a significant correction for a bank like HDFC Bank that has corrected by 3.74%. Now what is driving this correction? I will cut all the noise and come straight to the point. There are two big points about HDFC Bank that is causing this correction. You will hear this from experts that the two main reasons are, number one is the net interest margin. So NIMs for the HDFC Bank has been correcting a lot. If you see their Q2 results, you will see that their NIMs have gone down to 3.4% versus 4.1% in the June quarter. So that is a significant fall from 4.1% to 3.4%. What is a NIMs, net interest margin? Simply, if the bank is lending at 10% rate, but it is paying to its customers at a 7% rate, then it means 3% is the profit margin that the company or the bank is earning. That is called net interest margin in a very, very simple language. That net interest margin drives company's profitability. Also, it drives the NPAs or the bad loans. But in this case of HDFC Bank, it has fallen down from 4.1% to 3.4%. Now, what is driving this fall? If you go ahead and look at their commentary of their management, the two key reasons of this fall is what we need to understand. Number one is that during the merger, they were carrying the higher borrowings to manage the merger, and because of which the net interest margin has come down. That is reason number one. Reason number two is that you will see that RBI in the month of August asked every bank to maintain higher ICRR, which is incremental cash reserve ratio, due to which the bank had to keep more money with them. They couldn't lend it to customers. Therefore, the net interest margin have taken a hit, and that has happened to many of the other banks as well. HDFC Bank is not alone in that boat. All in all, from a net interest margin perspective, it has gone down, but it can improve very easily, because I think these are the short-term pains that the bank is right now seeing, because it is coming out of the merger slowly, and in the upcoming quarters, the net interest margin may improve, and that is where the stock prices will start to go back up to its previous levels. The second big problem that the investor community is right now seeing is higher GNPAs, which is the higher bad loans of HDFC Bank. And if we see the figures, it used to be only 1.17% in the June quarter. It has gone up to 1.34%. What is driving this higher GNPA? Again, if you read the management commentary, you will see here that the 22 basis point of this higher GNPA is mainly because of restructured account in erstwhile non-retail HDFC Limited. Meaning, due to the merger, their GNPA is slightly higher. It does not really mean that HDFC's bank's lending practices have gone worse, or they have got all of a sudden the bad loans. It is mainly the restructuring that is happening in the bank that is causing the GNPAs to be slightly higher. So I see that HDFC Banks, these two metrics going down is a short-term phenomena, and it is going to correct in the long term. And when that happens, that share prices will start to regain back. In my view, HDFC seems to be a very, very good buy right now. Again, not a recommendation for you to buy. I have simply presented facts to you and have done my analysis. And whenever I have personally taken any positions into HDFC Bank, I have very transparently shared it with my member community on YouTube. You can consider subscribing to my YouTube member community, because I share my personal investments in that community as well. The fourth stock that is in my list is UPL, which is world's fifth largest agrochemical company. And what you see here on my screen is that in the last 1 year, the stock has corrected by close to 25%. So this stock has been beaten down like anything. Last 1 month, if you see, it has gone down by close to 8.28%. and it went down to the bottom prices of roughly 532. It is slightly now going to pick up and gone back to 554 levels. Now what is driving this fall is what we need to understand. But more importantly, if you look at the PE of this company right now, 11.66 versus sector PE of 21, and the PB is also all-time low right now. What is causing this? Let's quickly go and let us understand this very quickly. So what you see on my screen is their quarterly results, and you will very quickly see that the last two quarters, June 2023 and September 2023, their profits have fallen down sharply. So it has gone down from 1000 crore to 100 crores, and now in the September quarter it has gone down to minus 293 crores. So the company has started to make loss. Now what is causing this is what we need to understand. So for this, if we go and read their management's commentary here, page number 14 of their Q2 results, Mike Frank, one of their CEOs, is talking about what is causing this fall, and he in fact explained this in the previous quarter as well, concept called as distributors destocking. So flashback 2 years ago, what distributors were doing for this business typically is that they were stocking more and more products. Why? Because 2 years ago during the COVID time, the interest rates were very, very low. So distributors had a lot of working capitals with them. They could borrow more money and they could stock the products. Also at that time, the supply chain was not very reliable. So they could not rely on supplies coming in time. So they were actually stocking a lot of the products at that time. Now what has that happened is in the last 2 years, they have built up a lot of inventories at their place. So now distributors have been trying to liquidate or sell or get rid of that inventory, meaning that they are not buying more and more product because of the inventory built up in the last 2 years. That is the reason number one, that why the company is seeing fall in their revenues as well as in profits. The second reason that the company mentions is that overall the company's sector is facing the headwinds in terms of price challenges. Naturally, if the distributors are not buying, the demand is going to be low, and what that will do is there is going to be a price war in the market. So right now the prices of these products that they're selling is going down, again hitting their revenues and profits. But if we read the page number 6 of their Q2 results, you will see that what their management is right now seeing is that the pricing front, the prices have been bottomed out in Q2. So hopefully the prices have stabilized, that they are not going to fall further. And also their management seems to be confident right now that in Q3 they are not going to give higher results than the previous Q3, but hopefully in quarter 4 the business will start to pick up. Now again, nobody can guarantee this. This is something that nobody can predict very accurately, but if you believe in the company's management, what you can do is you can take some positions right now, because right now the stock is bottomed out. As far as I can see, there may not be any massive corrections in the coming days, and this stock is for patient investors, the investors who can wait for at least 3 to 4 quarters patiently, watch the stock very closely and take the fresh positions. Again, I'm not recommending you to go and invest in this company, but what I can see right now is that the stock seems to be trading at a very low price because of the distributors stocking the product in the last 2 years. Now if the distributors start to buy the products again, what is likely to happen is it is going to have the revenues and profits of the company going back to its previous levels, giving the share prices a boost. Again, a disclaimer that I'm not suggesting you to buy the stock here at this price. I'm simply doing my analysis. You please make sure you do your own research about this stock before taking any fresh entries into this stock. So far, if you're liking this video, humble request for you to hit the like button. Also, you can consider subscribing to my YouTube member community, because I post in-depth exclusive analysis only for my YouTube member community, and I talk about various stocks, mutual funds and other assets that will help you make informed decisions. Now coming back to the fifth stock, it is TCS, and you see in my screen in the last 1 month, TCS has corrected by close to 7.27%. And in my other videos, I've talked about why TCS remains fundamentally good company, and 7% correction in India's largest IT company at this point in time, in my view, is a very, very good correction. Not a recommendation for you to invest. But right now, what I want to do is cover the buyback option of TCS that you would have seen in the news in the recent weeks. And if we do a quick calculation, let us look at the price right now is at around 3,400 rupees level. So if I do a quick calculation, you will see the current price of the stock is 3,400 levels. And if a retail investor like you and me want to participate in this buyback, and let us say buy 56 shares, so total investment is 1,90,000 rupees. Buyback price that the company announced was 4,150 rupees. So this is what is on their website, that the company is going to buy back these shares at 4150 per share. And if we do the quick calculations, 4150 minus 3400, the current share price is close to 750 rupees per share profit. The buyback dates are not yet announced, so I don't know when the buyback will happen. But if we do the quick maths, there are 4 potential scenarios that may play out. Acceptance ratio is 25%, 50%, 75%, 100%, meaning that out of these 56 shares, if you want to tender these 56 shares, company might accept at 25% rate. So that means out of the 56 shares, you might be able to tender back 14 or 28 or 42 or 56 or any numbers in between them. We don't know what the acceptance ratio will be. But if we do the calculations for the purpose of profit realizations, you will see that if you're able to give back 14 shares to the company, your profit is going to be 10,500 rupees. And if you're able to sell all 56 shares back to the company, your profit is going to be 42,000 rupees on your investment of 1,90,000 rupees. That is close to 22% of the profit. This buyback is going to happen hopefully in the next few months. I don't know when, but clearly what we see right now is there is some room for people to make profits. I'm again not at all recommending you to invest in this company. I'm just simply doing some analysis for you to help make the right decision based on your own research as well. And if you like my unbiased analysis, you can simply press the like button. Let me know in the comments a simple thank you. That will motivate me to come up with more such videos. Also, you can consider subscribing to my YouTube member community because I share in-depth exclusive analysis for my YouTube member community. I would now request you to watch this video. It will help you understand a lot about investing. I hope to see you in my next video. Until then, keep rocking.